Hi, this is Phil Greenwood from the Wisconsin School of Business, and this is the final podcast in our series of financial statement background podcasts as related to the Wisconsin Entrepreneurial Boot Camp. In this last section, we want to just give you a little bit of background on cash flow, and especially how it relates to startup or very young, early stage companies. We're not going to get too heavy into calculations or examples or anything of that nature, but I just want to make you aware of some key terminology and some key ratios that are used with startup companies, especially among investors, when discussing financial requirements and financial negotiations with entrepreneurs. If you recall, way in the beginning, we mentioned that the two important financial statements that kept track of activity during a year or a quarter was the income statement and then also the cash flow statement. Why we have to have those two separate statements is that even though they track the same categories of data, there's differences in the timing of the data. For instance, the income statement records sales when the sale is actually shipped or when the service is performed, not when the cash is received by the business. On the other hand, whenever there is an expense for, say, something like advertising, the company records the expense that it owes to the ad agency when the ad agency actually performs the service, not when the company pays the cash in the form of paying off an invoice. Now, in 1985 or 1986, the accounting profession came back and said, we need something that still tells us in a more straightforward manner what the direction of the cash flow is. In other words, the cash that comes into the company and the cash that goes out of the company. And they created a statement of operating cash flows, which helps take into timing differences and shows more of the true cash flow timing of the business. So as you can see on kind of this busy chart, it's kind of an outline of the breakdown of the cash flow statement and what goes into the three different components. The three components are the operating activities, which tries to reflect the cash flow related to the ongoing day-to-day sales and expenses of the company. The other component or activity is investing activities, which relates both to real and financial capital. And you can see the types of items that make that up. A good portion of it is in the purchase and sale of property, plant, and equipment, and things like that. And then finally, the third component is the financing activities. In other words, where's the money coming from when we sell stock or issue debt in the form of loans? Or where's the money going out of the company when we're actually buying back stock or buying a new company or repaying off a loan or paying dividends to our shareholders? So by splitting into these three categories, it's supposed to give investors a sense of, where is the cash flow coming to and going from, and help in making that timing adjustment for the income statement, which doesn't truly track cash flow. So this is just kind of a backgrounder to give you a sense of what items are connected to each of the major activities of the company. So if you recall back when we did that, I believe it was session 3, and looked at that startup company, Next Wave Incorporated, we calculated an income statement and a balance sheet for the company after 8 or 10 different transactions. Well, if we had to convert that to a cash flow statement, we'd be able to go back and say, well, we had income from the business of $2,000, and then we had in order to get to a cash flow number, we add back depreciation. If you can remember, depreciation expense, we had already spent the money on the plant and distribution center, the $7 million, but then we had to expense that as we used it over what we thought would be a 10-year life. So the reason why we add back depreciation expense is that depreciation is treated as expenses on the income statement to get to a net income number, but it's not truly a cash expense because we've already spent that, in this case, in the building of the plant and distribution center. Then you can see we have that 0.9 represents cash from operations. Then we have to take into account the changes in what we call working capital. Working capital are the changes in the current asset and current liability accounts. In this case, it was accrued expenses, accounts receivable, inventory. Namely, when a liability account increases, the impact is that cash increases, and vice versa. When an asset account increases, we actually have the opposite effect on cash. So as assets like accounts receivable increase by $4.9 million, you can see on the statement that it's a negative $4.9 million. It's showing the impact on cash. Same thing with the inventory. So in this case, we had working capital change, or the change in current asset, current liability accounts other than cash, of negative $6.9 million. So if you took the 0.9 cash from operations, subtract from that the working capital change, you'd end up with a cash flow from operations of negative $6 million. We then subtract out the purchase of fixed assets, add back the investing or the financing activities of common stock issuance, proceeds from the bank loan, and you can see, bottom line, we're able to explain what caused the cash to increase or decrease, in this case increase by $2 million from the beginning, from 0 to 2.0, and being able to compare that to what our actual income was. Now, what's important when we look at cash flow, especially in the form of new ventures, is to remember that with startups, rarely are there any revenues, much less profits, in the early parts of the company, in the early life of the company. And usually we have a lot of expenses, and many times the expenses are higher than planned, and so we see this tremendous increase in the early stages of expenditures. Many times the revenue may not keep up with it, or when we do hit a stage where we'll see an incredible increase of expenses to help fund the growth in revenue. But needless to say, typically in the early life of a startup company, especially a high growth one, we end up spending a lot of money and are required to seek outside financing. So what are some ways that companies look at this? Well, this is just a graph that's from the book New Venture Creation, originally written by Jeffrey Timmons out of Babson University. And as you can see, the importance of why we want to know what our cash position is it comes in handy when the entrepreneur is bargaining with the investors, the bankers, and such. As you can see, when you look at the horizontal portion of this graph, that graph says time in months to OOC. What that means is how many months do we have until the company is OOC, or out of cash. And on the vertical axis, you can see the RBP, or the bargaining power of the entrepreneur, as against the as versus the investors. And as you can see, when the company has little or no cash on hand, the bargaining power of the entrepreneur is little or no, the same as the poor cash position. On the other hand, when a company has a year's worth, 12 months or more of cash on hand, the bargaining position of the entrepreneur tends to be much stronger, may not even have to deal with investors. So that's why one of the major reasons why we want to monitor cash flow in the early stage companies. Three major things, or at least two major things, and then another acronym that goes with cash flow that we want to monitor is: one, the burn rate of the company; two, the OOC, which tells you how much time we have till we're out of cash; and then third, the TTC, the time to cliff, when the company actually fails. In the startup mode, we tend to want to monitor these three, or at least these top two ratios, very closely, many times wanting to know the cash position, if not on a monthly basis, sometimes even on a weekly and a daily basis. So what about the burn rate? Well, what the burn rate is simply taking what our cash from operating activities, which can be negative or positive, and that includes the income or loss, add back depreciation, offset by changes in working capital, gives us cash from operating activities, and you add or subtract any cash that comes from selling equipment or having to buy equipment. Now, in the early stage company, typically you're making capital equipment purchases for things like computers, machines, and such. Once you've added those two together to come up with a cash flow number, typically what we call a cash burn number, in the early stage companies. We then divide that by the number of days over the period we've obtained the data from. And so in other words, if we have cash from operating activities and equipment purchases over a year's time, add those two together, divide that by the 365 days in a year, and what we'll be able to see is how much cash are we spending on a daily basis. Or in other words, what's our cash burn rate if we're spending more than we're bringing in. If we're actually generating cash, that's considered our cash generation or cash build rate. But what this tells us is how much cash are we spending on a daily basis, or in some cases you may only want to make it weekly or monthly, but it gives you a sense of how long will our cash last. Now, how do we determine how long our cash will last? We look at our OOC, or out of cash. We simply take the amount of cash we have on hand today, or whatever day is of the balance sheet date, and divide it by that daily burn rate we just calculated on the previous slide. Taking the dollars on hand divided by the dollars spent per day will give us a number of days that we have until we run out of cash. In other words, our OOC. As a company, you want to watch this because you typically want to monitor or maintain a position of having X amount of months of cash on hand. Many people try to maintain at least 12 months cash on hand in order to maintain that strong relative bargaining position.